So we start off with Centrica's most recent announcement regarding Rough. So on Friday they announced that they were going to see the permanent close of one of the platforms related to withdrawals, and that's going to impact overall withdrawal capacity of about 3 MCM per day. In the grand scheme of things, this is a relatively minimal loss versus kind of the ongoing issues we're having with Rough, and as a result we've seen very little price action associated to that announcement. Sticking with gas fundamentals, last week we saw a really strong oversupply throughout the week, and this week's no different. We're seeing really strong gas flows from the UK continental shelf as well as from Langled. We're seeing stronger gas flows from Langled as a result of maintenance on the Norwegian continental shelf that's seeing gas rerouted to the UK instead of the continent. That is expected to dwindle later in the week, but we were expecting a bit of a correction over the weekend, and it's still not happened. So there is an opportunity that those gas flows could continue later this week. Finally, LNG, we've seen the schedule quicken over the last week or so, and as a result LNG send out is stepped up again at about 40 MCM versus kind of 20 a couple of months ago, and that's again adding to the system oversupply. Looking now at power fundamentals, it's kind of the polar opposite. So the start of this week we've seen very tight supply margins forecast as a result of an unplanned outage at a nuclear plant, and on top of that renewable generation is also expected to dwindle later in the week, with wind speeds kind of curtailing quite significantly. On top of that, we're expecting much warmer temperatures than originally forecast, and that should see air conditioning demand increase and in turn see overall demand for power consumption increase. Finally, looking at oil, we saw quite a strong sell-off late last week and the start of this week, and that's been a result of data that's come out with regards to the US rig count, so the number of operational oil rigs in the US. Over the last 11 weeks, we've seen 10 weekly increases in the rig count, and that's the kind of the longest streak of increases since 2011, and that's just adding some downward incentive to oil prices. So if we start off looking at gas prices, as a rule they're actually trading lower at the moment. So contracts close to delivery, they've been weighed upon by this increase in gas that we've just mentioned. So the fact we're getting strong Langled flows and strong LNG send out, that's seen the system regularly oversupplied and has pushed contracts close to delivery down to 7-year lows. The fact that those contracts are so cheap, that's having a downward incentive on seasonal prices, which are now back to levels seen in April before we saw the big push up earlier in the year. In terms of power contracts, those close to delivery are actually trading opposite, so they're trading much higher at the start of this week. We've actually seen the day-ahead contract trade at 3-year highs, and that's been linked to the system tightness that we've just mentioned in relation to kind of increased consumption with warmer temperatures and the unplanned outages on the nukes. In terms of oil prices, they're still relatively range-bound between $40 and $50 a barrel. At the moment, prices are softening, and that's been linked to this increase in the US rig count. However, going forward, OPEC's meeting at the International Energy Forum on the 26th of September is when they're potentially going to discuss freezing production, and that itself might provide some upward incentive over the short term. So customers looking to place a fixed price contract should look to do so pretty soon. If we think about where the deadline for October 16 sign-in is, we're approaching that quite quickly. The fact that prices have softened over the last number of weeks is also giving opportunity so that customers who are entering a fixed price contract can do so a little bit cheaper. I would urge customers that are looking to sign for doing it over a 3, 4, 5-year period, as the prices, seasonal prices further out are actually cheaper in terms of power than they are for the October 16 contract, which will act to potentially mitigate some of these rising non-commodity costs if you can secure a lower commodity cost out into 17, 18 and 19. In terms of customers with flexible contracts, it's down to attitude to risk again. Moving it further into Q4, there is potential for more downside. As we've mentioned, the system's currently really oversupplied in terms of gas, and that's expected to continue over the short term, which could see prices cheapen. However, I would act very cautiously because moving into the winter, if we got an early bout of cold weather, given the kind of the supply security issues we're having regarding Rough, we could potentially see some very volatile price action. So you need to make sure you're in a position where you are able to optimise if you want to, but also you are aware of the risk going into the winter, and should things turn sour, you need to be able to quickly mitigate any damage.